Well, this week is the kickoff to Canadian bank earnings, with RBC and TD reporting results tomorrow. Our next guest says slower loan growth and credit concerns are setting a low bar for the third quarter. Let's bring in Nigel D'Souza, senior investment analyst for Veritas. Thanks so much for joining us today, Nigel.
Thanks for having me.
So where do you expect potentially the biggest weak spots to be for this quarter for the bank sort of overall?
I think what everyone's going to be paying attention to is the net interest margin and what's happening on the funding cost side. There's a lot of funding pressures at the moment. In Canada, we have depositors moving their money from lower yielding demand and notice deposits, that's your checking and savings account, or return deposits, which are GICs. That's going to increase funding costs in Canada. In the US, it's a different story. You have money moving away from non-interest bearing deposits or just leaving the bank altogether to go to a larger bank or a high yielding alternative like money market funds.
And that's not something that we've seen so much happening here in Canada, that sort of outflow of funds from the banks.
Yeah, so in Canada, I call it a deposit fight. It's a fight to keep costs down. In the US, it's a deposit flight, which is deposits actually leaving institutions because deposits are a lot less stickier in the US banking industry than in Canada. In Canada, you put your money with the big six banks and there isn't much of an alternative. So deposits stay in the bank, but they go to higher yielding term deposits in Canada.
So how do the banks here do that, fight to keep costs down?
I don't think they really can because it has to do with the interest rate environment. It's something that's out of their control because the higher rates go, the more incentivized depositors are to put their money into term deposits. If you look at the level of term deposit mix for Canadian banks, it's around 48% right now of total deposits. Post-financial crisis, it peaked at 51, 52%. So we are heading on the trend of matching that peak. But if you go back to when rates were this high in early 2000s, so 2001, term deposits were closer to 70% of the total mix. So there's still a pretty big runway and potential for deposits to continue to shift to term, and that's going to weigh on net interest margins.
On the lending side of things, that I'm guessing is slowing. I mean, we haven't seen the pickup in the housing market continue on the residential side of things, but there's the commercial side of things to consider as well. What will you be looking for on that?
So on the loan growth side, it's going to be a mixed picture. When it comes to non-revolving credit, so think of mortgages, term loans, that's going to be lower demand and slower growth because it's just simply not affordable for a lot of businesses or households to take on term debt at this rate. But the revolving credit part, which is your credit cards or lines of credit or credit facilities that businesses rely on, that's actually going to see higher loan growth because when you're in a period where the economic environment is more challenging, households and businesses need liquidity, so they pull on those revolving credit facilities. So I think you're going to see a mixed bag where mortgages, term loans, commercial loans slow down, but credit card balances are going up, and maybe businesses are pulling more on their credit facilities. Does
that end up balancing things out for the banks? I mean, when you're thinking mortgages, that seems a lot bigger, hopefully, than credit card balances are. But those, the interest costs on credit cards are pretty steep.
Yeah, I think net it will balance out. If you go back and look at past recessions, it's very rare for the loan growth, the loan book to shrink. So you typically still get loan growth, just lower loan growth and maybe more flatter or flat-ish loan balances. And the risk really isn't in the loan growth side of the book. The book is not going to expand or contract significantly in a short period of time. The issue with banks is what is the margins they're going to make on their lending book and what are the credit losses that they could potentially experience as we go through a cycle and a potential recession.
Yeah, what do you expect to see when it comes to credit losses? How are we going to see that sort of play out, do you think?
I think you're going to see a continual normalization of credit losses. We're going to continue to move to the pre-pandemic level. Now, in order for credit losses to move meaningfully, you need unemployment to go up and you need debt servicing costs to go up. Both of those haven't moved up significantly so far. They may in the future. They likely will, at least for debt servicing costs. So I think we're still a few quarters away from credit losses really accelerating, moving above what we saw pre-pandemic and potentially peaking out. This quarter, you could see some noise. You could see idiosyncratic losses from commercial real estate, but nothing that I think would cause outsized issues for banks. It's more so the underlying trends for the broader consumer portfolio and the commercial portfolio. That's what we're going to be paying attention to.
What sort of a picture do you think that this quarter is going to paint from the banks when it comes to the economy as a whole?
I think it's going to show that we're definitely later in the economic cycle. The question is when or if we enter in a recession, when does it happen? And if we do enter in one, how severe is it? That's still a big question mark because a lot of it depends on the pathway for interest rates. When do we get rate cuts? If it's next year and we are higher for longer, debt servicing costs are going to continue to go up, and that's going to strain the economy. It's going to strain banks. This quarter, we're going to be paying attention to loan growth, credit losses, and what the outlook is more so than what the results are in this quarter, and also the prospects for whether banks can actually maintain their margins and grow earnings. Because I don't think a lot of the downside risk for earnings in 2024 is currently reflected in consensus estimates.
Is there anything RBC specific or TD specific that investors should be watching out for as well?
I think for RBC and TD, we're going to be paying close attention to what's happening with their U.S. banking segments or franchises. For RBC's case, they do have a small franchise called, well, small relative to TD, but they have a franchise called City National Bank in California. That's where we've seen regional banking issues in the U.S. TD's more Eastern Seaboard or Eastern Coast oriented in U.S. banking, but there's still deposit pressures, there's still outflows, there's still concerns of funding costs going up. We're going to pay attention to that. And then credit risk. What's the credit risk and credit experience like, and how is it developing for the mortgage book for both RBC and TD and across the broader portfolio? And
when we're looking at these stocks, I mean, your ratings aren't on them aren't super favorable in terms of you got to sell on BMO and CIBC, a reduce on Scotia and TD, but a buy on National and RBC. I guess maybe why the buys on those two, on National and RBC?
I think it comes down to the risk-adjusted margin. Like, that's what's going to determine which banks outperform or underperform over the next few quarters or through the cycle. And when we think about the risk-adjusted margin, it's two things. It's your net interest margin and it's your credit losses, right? So National Bank is concentrated in Quebec. Quebec typically experiences a lower level and a lower ceiling of credit losses through a cycle than banks that are in other provinces or that are in international banking markets. That's going to help the risk-adjusted margin because even if the margin doesn't expand or contract, your credit losses are lower. So National Bank's going to outperform. RBC has a really strong deposit franchise. They have a very strong core deposit franchise. They're typically able to have deposit costs go up less than other banks. That should benefit it. So there are different reasons why we like both banks. For National, it's lower credit losses. For RBC, it's probably better margin performance through the cycle.